to go to the actual YouTube live stream, unless you just want to watch it here, but you won't be able to see my screen or anything. But for sure, if you guys are on Instagram and you have questions, leave it there.
The Federal
and
Reserve
I will
System
try
works
and,
every day to support a growing and stable U.S. economy. Across the United States, the Federal...
Turn down the FOMC. So for those of you that joined on YouTube, welcome. We're also live on Instagram. Decided to do live both. First time actually going live on Instagram. But we are here to stream the FOMC meeting, the Fed meeting. Let me know that the levels are good. Let me know that you guys can see me, you guys can hear me. Apologies for not going live yesterday. I wasn't able to go live yesterday. Wasn't feeling that great. But we are here now. So let's check on the pre-FOMC action. They should actually have already released the interest rates by now. Let's see. Fed raises interest rate 0.5 point to highest level in 15 years. This is what we expected. We expected them to raise it by 50 basis points, right? So they raised it by 50 basis points. Not a surprise. We did get, remember, the CPI was a little bit less than expected, 7.1 versus 7.3%. However, services inflation is definitely seems to be sticky, which is part of the reason that the market did rally that day during the CPI reading, but then actually lost all of its gains because of the fact that some parts of the inflationary picture seem a little bit stickier than normal. So we do currently have a strangle out on the triple Qs. This was up 15% before we started the live stream. We're hoping for a much bigger move because we have the 295, 285 strangle on the triple Qs. So we're hoping for a much bigger move, in which case we will close the side that's in profit and leave the other side open. We're currently up around 10%. I have 10 strangles. So the puts are up 131%. The calls are down 76%. So we can actually close the put side once it gets to a level that, you know, we are okay with. We can actually close the put side now and leave the call side open. Obviously, you are risking potentially the market continuing down further and prematurely closing your put. So we will actually wait. Even though I could take 10% profit here, I'm actually going to wait to see what Jerome Powell is doing or what Jerome Powell is saying, because we are going to be getting his speech, his testimony, right? We'll know what his expectations are, whether he sounds hawkish or dovish, etc. So let's look at the dot plot and terminal rate. Let me find that. Let's see if they updated this. Okay, so the Federal Reserve on Wednesday raised its benchmark interest rate to the highest level in 15 years. They raised it by 50 basis points. So right now the target rate is between 425 and 450 basis points, which is the highest level in 15 years. Let's see what the terminal rate is expected to be. So the reason that this FOMC is huge is because the summary of economic projections was also released. The summary of economic projections gives us the dot plot as well as the terminal rate. The dot plot is what the Fed members are expecting the Fed funds rate to be next year. And then the terminal rate is the rate at which the Fed is expected to stop hiking. It doesn't mean that that's the rate at which they're going to pivot. They could keep it at the terminal rate for a long time. So let's look at the news on that. It says the expected terminal rate, or point where officials expect to end rate hikes, was put at 5.1%. This is higher than expected. If you recall my last video, the expectation was around 4.88%. That was most of the expectation. So doubled on the 390 TTE SPY put. Thanks for mentioning. Yeah, I'm not sure what that comment means, Mark Fayer, but all you need to know is the dot plot, says Bryce Richards. So 5.1% is the expected terminal rate, and that is basically determined by the Fed members putting in their dot plot expectation. So they take a collection of everyone's expectations, and that's how they get to the terminal rate. So let's see. There was a fairly wide dispersion in the outlook for future years, indicating that members are uncertain about what is ahead for an economy dealing with the worst inflation it has seen since the early 1980s. All right. Rates rising above, blah, blah, blah. Okay, so the newest dot plot feature multiple members seeing rates heading considerably higher than the median point for 2023 and 2024. 19 committee members, voters and non-voters included, saw rates rising above 5.25%. So there seems to be some difference on opinion there with regards to the dot plot and with regards to the terminal rate. All right. Let's see. Any other poignant facts here? Let's see. Labor Department, Consumer Price Index rose just 0.1%. Blah, 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 blah. All right. Non-farm payrolls grew by a faster than expected, 263%. Yeah, we talked about that. All right. So this is all pretty much old news aside from the rate hike itself. The dot plot, which is showing a pretty high expected terminal rate here, as well as the terminal rate itself, the median level terminal rate at 5.1%. So yeah, let's see. Let me get to your questions. Chat, leave me your questions here so I can get to them. All right. It says loud and clear, great on my end. Why is the market sinking? Why not? Because the terminal rate is higher than expected. Huge news on the dot plot. Yes, doubled on the 390 DTE SPY put. Cool. I went with no risk. Do not have an open position. Do you think that this meeting will set the trend for the next month? Yes, I think so. You mentioned in the Discord group that since the market is up, you're going to scale into the put side. So I thought, why not try 0 DTE put? Oh, yeah. Good job, Mark. All right. Any questions from you guys before we dive into more of the market? And let's see how the market is currently reacting. As you could see, that terminal rate is scaring off the market so far. Don't be surprised if we do see a huge turnaround. We have seen some crazy turnarounds in the market on FOMC days, on CPI days. So right now, we are seeing a drop of about 1.5% since the news came out. So let's see if we get to this support level here on the Qs at 281 on the SPY. Let's see what is going on. So same drop on the SPY. We are seeing a drop of about 1.3% since the news came out on the SPY. We do have a support level at around 390, 392. That is where the current support stands. So I do expect to see a bigger move here when Jerome Powell starts talking, because it's going to determine how hawkish or dovish he sounds. And obviously investors will be picking apart his every word, trying to see how hawkish or how dovish he is. But I do expect either this support level here on the SPY at around 390 or the resistance level at around 414 to be hit, depending on what Jerome Powell says. But as of now, the news is ultra bearish, not because of the 50 basis point rate hike that was expected, but more so because of the terminal rate and the dot plot seeming to be a lot more aggressive than thought. So yeah, and for those of you guys on Instagram, what's going on? If you guys have a question, let me know. Also, know that I'm live on YouTube. So click the link in the bio or the link in the last story if you want to join the YouTube live. How do you expect the dollar to perform against the euro or other currencies? Well, we could take a look at the dollar chart real quick. The dollar is continuing to rise as of the news of this announcement because of the higher expected interest rate. So I do expect the dollar to remain strong in this high interest rate environment, stronger than other currencies, to be honest. We are at major support here between 100 and 105 on the Dixie index. That is really the level to watch out for. If we break below that, then we could start talking about a breaking of a larger trend. But yeah. Let's see. Will there be a Santa rally now that there's no more uncertainty in the short term? I don't know that there will be a Santa rally. I think it really depends on what Jerome Powell says right now. That's going to determine whether we see a Santa rally or not. The strangles are back up to about 12%, 13% on 10 contracts. It's about $300. Again, I could close these now, but I'm in it to win it. So I'm going to wait until Jerome Powell starts talking. If you guys are in this play, go ahead and take profits if you wish. Other than that, we are going to wait for what Jerome Powell says. He's going to be taking the mic in around 19 minutes. So any questions that you have for me until then, let me know. Also, here is what I'm going to tell you. This weekend, on Saturday, we are doing a webinar. We're opening this up to the public. We're doing our normal call that we do, but we are opening up our mastermind call, but we are opening it up to the public. So join the mastermind call. You will see that link in the description. It is absolutely free, but once spots fill up and they're taken up in the Zoom room, then it's gone. So make sure if you want to join that free webinar Saturday, December 17th at 12 p.m. Eastern, we're going to be going over day trading, futures, options, etc. Again, it's going to be absolutely free to the public. So if you guys are not part of the academy, you're still free to join. Come see what all the hype is about. The link is in the description. So click that. And then if you guys are interested in joining the academy, make sure you do so before the end of the year, because our prices are going to go up for 2023. So take advantage of year-end pricing. All right. Please don't update the score of France-Morocco. But if you're asking me who I'm rooting for, I'm definitely rooting for Morocco. That is for sure. I do want to see Morocco and Argentina in the final. That would be dope. All right. Let me get to your questions. Oh my God, we got some insane donations. So thank you guys for donating to St. Jude's. Roman donated $57. Roman is always donating. Appreciate you, Roman, for always donating. Thank you so much. Richard Soren donated $20 to St. Jude's. We did hit that $7,000 mark. Appreciate you, and I'm sure St. Jude's appreciates you even more. So how come the VIX still relatively steady? Possible move post J. Powell. Yeah, I mean, you're going to potentially get delayed moves in the VIX, but we haven't heard what J. Powell has to say. 15 minutes until he takes the mic. So Gurinder, what is a liquidity grab? A liquidity grab is what happens when, it's a form of what we used to call, or still call, stop hunts. But basically, it's when the market looks for liquidity, usually below technical levels, where traders have their stop limits, right? So it's where institutions go looking for liquidity because they know a lot of orders reside below these technical levels, since a lot of people are using basic technical analysis in order to trade. So if everybody's trying to go long at support, well, where are institutions going to find their liquidity from, right? Institutions are going to find their liquidity by taking out people's stop limits, because that, again, if everyone's trying to go long at support, well, how are institutions going to get their longs in too? Who are they going to buy from? They need someone to sell to them at support. So what they do is they try to push the price down in order to grab everyone's stop limits that are sitting right below support. Case in point, this is a definition of a liquidity grab. So you have support here, right, denoted by this wick. Look where this wick reached to. This is all institutions coming down, grabbing everyone's stop limit orders and riding it up. And they're doing this all day for, small gains, but for millions and millions of dollars. So small percentage gains, but for millions of dollars. So anyway, that is it. We're down currently, down about 16% on the strangle. Again, could have taken profits at around 15%. Not surprising considering all these jumps that we are seeing. I am not taking profits on this because I am not playing for a small move. I want to hear what Jerome Powell has to say. In the Discord, one of our analysts, Dr. Flox, had updated. Let me see where this is at. Weekly updates had updated this, showing what happens every FOMC meeting, both to the Qs and the SPY. So I'm waiting for these big moves because generally from 2:30 onwards, we tend to see these huge moves. There was only one time where we didn't see a really big move, and that was back in September. We still saw a 1% move, but 4.3% in November, minus 4.3%, 2.2% positive in July, 3.6% in June, 4.7% in May, 3% in March. So usually after Jerome Powell starts talking is when we get the big move. So I'm waiting for that. Obviously, again, you could take profits if you wish. But yeah. All right. Any questions from you guys? Guys. Okay. All right. Soner, thank you so much for your donation to St. Jude's. Appreciate you. Let me see if there's any more updates on the Fed funds rate or the dot plot or anything else. Let's see. And let me get to your questions. Okay. Soner, thank you for donating 10 pounds to St. Jude's. Do the legacy Patreon members keep paying the same price? As long as you're still in, yes. If you step out, then no. Guys, stop being assholes and updating with the soccer scores, okay? Please. You know what? This guy's annoying me, actually. All right. Is Academy in addition or included? Yes, the courses, the Zoom calls, the Academy, everything is included. If you sign up before the end of the year. Will you post the last Zoom for drawing support and resistance? Already did. It's in the Zoom channel already. Soxel, right time to buy. You're very late on Soxel, Annie. We bought Soxel at $8, I think. A little less. Some at $7, some at $8. Could we still enter your strangle, or is it too late? If you know what you're doing, yes. If not, then no, because that strangle currently is at a discount. So if you know what you're doing, sure. So would this be the start of the pivot? No, pivot means when they decrease the interest rates, right? Like when they turn around. This is not a pivot. They're still raising rates, and it's the highest that it's been in 15 years. So, all right, we're just waiting on Jay Powell another 10 minutes. Crack over weed. It helps with my trading abilities. I think some people are starved to be comedians, but they're not very good at it. Is Z long or short? Both. A strangle is when you buy both a call and a put. And you need a big move in either direction in order to profit off the strangle. Again, we could have closed the strangle, but I'm waiting for a big move because of the analysis here, right? Right here. So, all right. Let's see. Recession guaranteed by the Fed. Yes, the recession is guaranteed by the Fed. Market coming back up again. Sushant, you must not be familiar with FOMC days. They're going to fuck with your emotions for as long as you look at the chart. We're going to see ups and downs. This is going to continue where the market is taking liquidity at both buy side and sell side until Jerome Powell starts speaking. So at 2:30 p.m. Eastern time, which is in 10 minutes, you're going to likely see very large moves, right? All right. He's hawkish in the statement. We didn't hear him talk yet. So let's see. Mark, you're doing a great job, my friend. Appreciate you. For long-term holds, no. If you're talking about the strangle, that's not a long-term hold. No. What is the strangle you're in? It's posted in the Academy, Rock. If you're part of the Academy, you'll see it in there. Any futures plays. I am managing a strangle right now and trying to do this. But check out the Discord for some of the other analysts. They might be posting their plays in there. Why will Fed pivot tank the market? It's not that a Fed pivot will tank the market. It's by the time the Fed pivots, shit is usually bad. And by shit, I mean the unemployment rate is bad. Spending has gone down, and usually the earnings are very muted. So the Fed does not pivot until that happens. Michelle, what's going on? Appreciate your donation. Thank you so much, Michelle, for donating $20. Thank you always for showing up and always donating. Appreciate you. Any SPY futures move? SPY is an ETF. It's not a futures. SPY has options, not futures. So I suggest paper trading until learning the basics and the difference between futures and options. How do you see today's 50-point increase in tomorrow's jobless number? Today's 50-point increase is what was expected, but the market is moving based on a worse than expected terminal rate, right? 5.1% is higher than everyone expected. And we are seeing some on the dot plot at 5.25%. So if you look here at the summary of economic projections, let's see. It was in this article earlier. Wonder why it's not here. Hold on, let me see. Fed dot plot. Okay, let's go to Barron's. All right. Peak interest rates to 5.1% from 4.6% in September. Yes. So the median forecast for the dot plot, again, was 5.1%. It was thought to be 4.6% in September. So much higher than expected. And the dot plot, it says the central bank will also release its latest dot plot. We already have the dot plot numbers though. So some members were at above 5.25%, which is a lot higher than what the market wanted. So this, all that means, chat, is that means that the Fed is likely to increase rates higher than what was expected for 2023. That is going to put pressure on the economy. That is going to put pressure on employment, which is essentially what they want. And that will likely tank the not only the economy, but the markets as well. So what's your strangle expiration? It's 0 DTE. Glad you're feeling better, Z. Appreciate you, Michelle. Vivian, what's going on? What do you think gold stock is going to do? We can take a look at the gold stock, Vivian. Gold, here's what I say about gold. Gold is not a way to make money, right? It's a way to preserve money. It's not a way to make money, in my opinion. It did break out of it used to be support that turned into resistance. And we broke out of that. That was really the time to optimally buy gold. But, you know, again, you should not expect to make money from gold. It's really a way to preserve money. It's okay to start scaling into GLD at these levels, in my opinion. These are levels that we saw right around the COVID crash of 2020. So, but I don't really look to GLD to make money. It's just a way to store cash. I do play gold futures more than GLD, but yeah. it is nearing the point of control now. The point of control is the point at which the stock has seen the most volume. So, you're not getting a great price. You're not getting a terrible price. This is right around where investors going all the way back to April 2020 have agreed that that GLD was fairly priced. So, all right. Yo, Z, thanks for bringing info to the people. Appreciate you, Andre. Okay. Not the strangle. I mean, buying a signal for long-term holding. You're way too late for that. You're way too late to buy here for long. You don't buy at resistance. You don't buy at resistance and you don't sell at support. You are right at resistance. Why would you buy stocks here? Right? You buy stocks when it either makes a new low or matches a previous significant low. You don't buy stocks at resistance. So I'm afraid, in my view, you are a bit late. But do what you want, Noor. The range is actually 5.1 to 5.4, Bryce Richard says. It's in their economic projections. Okay. We have Powell talking in 4 minutes. Let me see if I can get the summary of economic projections up. But yes, I mean, if that's the case, Bryce, that is insane. Much higher than anticipated, right? Actually, is it in this Barron's article? Let me see. Projections. I don't see 5.4. It's not in this article. Give me the article if you have it, Bryce. But I'll take your word for it for now. If it's 5.1 to 5.4. Mazen, appreciate you. JT, do you trade Forex? No, I don't. What effect do you think this will have on bonds? Yeah, this is a very good question. Let's take a look at bonds because I bet you anything that bond yields are going up. Yeah. So if you take a look at TLT, it's down and it's right at the golden pocket. This might be a good short on TLT right here. But, if rates are expected to go up, then you could see yields actually going up as bonds go down. So yields are like the 10-year note is up 1% today. So yields are slightly up because of the fact that the Fed is expected to raise rates higher than expected. So if bond investors are expecting rates to be higher, why would they lock in rates today, which is why bond yields tend to go up when interest rates are expected to go up, right? So, yeah. If Jay Powell burbs a little in his mouth, expect all-time high by end of the month. I linked it. Bryce Richard says, I will find it again. Okay. Is Tesla in a buy zone here? I mean, I don't know what the hell Elon Musk is doing, honestly. This is not a good look. And this report just came out today that Elon Musk has reportedly stopped paying rent and told staff not to pay vendors. My God. I mean, talk about 2022 being the year of billionaire self-sabotage, right? Elon Musk along with Ye. I don't understand what he's doing, honestly. I think he overpaid for Twitter and is now really trying to grasp at any possible way of not wasting money, right? He paid $44 billion for a product that's worth 10. So right now, Tesla is a falling knife to me. It does have okay support between 120 and 150. I told you guys that I thought Tesla would get there. I said that, once Apple and Tesla hit levels that seemed impossible to investors, that is likely when we will see a bottom, because Tesla and Apple were holding up pretty well through the bear market. But yeah, Apple is the best, is the stock that held up the best, right? It's still trading at above 140, which is crazy. So Apple hasn't really had a fall from grace, but once Apple hits, the 120 or below levels, and Tesla goes below 150, that is when I think we'll start to get some capitulation, right? Let's see what the stock market. Oh, shoot. No. Sorry, guys. Let's listen to Powell, and I'll answer your questions after, I promise. Whoop. Just waiting on Big Jerome Powell. Any minute now. While he's doing that, let me see what the market is doing. And for those of you guys on Instagram, we are live on YouTube. Hit the link in the bio or the link in the last story. Unfortunately, I cannot screen share on Instagram, but all the screen sharing is happening here on YouTube. All right, so the market is still testing the support level, this liquidity grab level. It's basically a gap fill from yesterday. It's this gap here on the SPY, creating a bear flag. And if Jerome Powell is really hawkish, we might see
Good afternoon.
A major drop. Okay.
Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing, and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows that, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe. Yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick.
Thanks, Nick Temeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report that had come out last week, do you think it would have changed some of those forecasts in today's S&P?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel?
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
So it's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby?
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today, and as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought. Right, so we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the largest, the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases, we want strong wage increases, we just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience.
Do you guys have any questions from what he said so far? So it looks like the market is reacting pretty bearishly, not as overwhelmingly bearish yet. Obviously, he hasn't stopped talking, and we tend to see the market, after he stops talking, really do a continuation move in the direction that it started in when he started talking. So, he did say a few things that were bearish, keeping rates higher for longer than they thought. Rates higher than they thought. Unemployment rate would have to be higher than they thought at around 4.7%. Also said that core inflation was a lot higher than they thought it would be towards the end of the year, which is really what is fueling all of these higher projections on unemployment, on the terminal rate, on the length of time they're going to keep rates for open for longer. By the way, we took profits during the call. We took profits on the strangle. So for those of you that were here since the beginning of the call, you know that we did a strangle on the triple Qs, closed it at 50% when it made that big move down. Basically opened the 285 put and the 295 call. And that strangle was up 50% on this big pop down here. Let me just expand this. This is the triple Qs. I want to talk about this dot plot for a second, so I'm going to put it aside. But on this big move down, that strangle was up 50%. You could have made a ton of money if you just played the puts. But we're not in this to guess, right? I would much rather take a guaranteed healthy profit than try to guess one way for either a bigger profit or a max loss. So we played a strangle on CPI as well. And we also played a strangle, which we ended up netting over 50% on that. played a strangle on the triple Qs, netted over 50% on that as well. So 2 over 50% plays on the 2 binary events this week, the CPI as well as the FOMC. Proud of the team, proud of the academy. Again, if you guys want access to all of our trades in real time, the link is in the description below. Take advantage before the prices go up next year. There is a year-end pricing sale, a massive year-end pricing sale. And for those of you that are just joining as well, we are doing a free webinar this weekend on Saturday, which is basically the mastermind call. So we are doing that this Saturday as well. We are going to be going over day trading, futures, options, charting, etc. You definitely don't want to miss it. It's absolutely free. Once the spots fill up, they're gone. So make sure you go ahead and sign up if you would like. So right now the S&P is down about 0.7%. Nasdaq is down about 0.98%, and the Dow is down about 0.7%. Jerome Powell hasn't officially stopped talking yet, but definitely a much more bearish stance, citing higher unemployment, a higher terminal rate, inflation being a lot stickier than they thought, holding interest rates for a longer amount of time. And here's the dot plot. Here's the dot plot that he was referencing for 2023. Most of the Fed members, 17 of the 19 Fed members who voted on this, came in higher than 5%, and some near 6%. So a much higher projection this time around than the last Fed meeting. So yeah, I mean, right now we are at between 425 and 450 basis points in terms of the Fed funds rate. And could get a lot higher than that very soon. So we will likely do another 50 or 25 basis point rate hike in February. And then the Fed will likely hold that and see what happens, right? Hopefully at that point, the unemployment rate hasn't shattered into oblivion, or gone up, I guess, into oblivion. So right now they are projecting the unemployment rate to be 4.7%, which matches what we saw back in 2016, which would be the highest unemployment rate that we've had since that time, right? Minus obviously what the flash crash that happened during COVID. Any questions from you guys? Do you guys have any questions on how to play strangles, on any certain technical analysis or whatever? Let me know. No rate cut talks yet. No. Why is VIX falling? VIX is falling because the information is already out. Why would you expect it to go up? That's the question I would ask you. The information is already out. So why would you expect it to go up today? Now, after the information is digested and after the market, maybe makes a determination of what that means going forward, then you could see a rising VIX. But right now, we are still at resistance. If you take a look at the SPY on the daily, we're still at this resistance here, right? So if we split up the SPY and the VIX, check this out. Here's the VIX and here's the SPY, right? So you need the SPY to start dropping for the VIX to go up. So the VIX is at support and the SPY is at resistance. No reason for the VIX to spike. Why would the VIX spike if everything so far is known, right? When are you planning on buying the yield bonds? I'm not planning on buying bonds. I'm planning on buying futures, but not yet. Not until we get sort of an inkling that we're going to slow down on the rate hikes. Puts on the SPY. If you have a portfolio to hedge, sure, you can play puts from this level. Calls on SQQQ. SQQQ has terrible volume, so I don't play options that have bad volume. I was expecting a huge rally. Why? Where do you guys get these expectations from? All right. SPY mooning. No, SPY is down 0.25%. I wouldn't call that mooning. Do you buy 2 separate orders for the strangles? You can do it in 2 orders or 1 order. You could do either or. If you're going to separate your strangles, right? Meaning that if you're going to buy the calls at one point and then wait a minute and then buy the puts, then, you know, you do it in 2 separate orders, obviously. The market is confused. No, you guys are looking at a binary event. What do you expect? I don't understand what is it that you guys are expecting. It's a binary event. Shall you go puts on TLT with the higher rates? No, maybe on the futures, maybe on the 2-year futures. Powell just said soft landing is possible. Yeah, he also talked about the potential for not having a recession, but we all know we're going to have a recession. Should we expect the NASDAQ to recoup a little bit before close? I don't know. Nobody can tell you that. That's not how you trade. You take the optimal trade. The optimal trade was to trade a strangle before this, which is what we did. Close the strangle at 50%, and we're done. No need to guess what the NASDAQ is going to do before close. Again, that's not how you trade. 10 years should rise instead of rising. I don't know what that means, Victor. 10 years should rise instead of rising. I don't know what that means. Should we get our hands on some gold and silver now? Not for me. If that's your thing, that's your thing. Gold and silver is really not my thing, to be honest. I do have some gold, but I would not call myself a gold investor. Can you do a live trade one of these days so we can see? Yeah, I live trade all the time. And we just had a live trade right when we started this. Fade the rips, enough said. What is the best platform for paper trading in futures? Thinkorswim. Calls on gold and metals. No, guys, look at gold and metals during recessions. They are not safe havens. They tank as well. All right, Rob, thank you so much for your donation. Appreciate you. Appreciate you. All right. Since we're at SPY resistance, are you looking for puts? Yeah, I don't mind opening a put spread here. I might do a put spread, not puts, but a put spread. What do you think we will have max IV? Have no idea what you mean or what you're talking about. Be specific, Rakeem, please. Why are they afraid of the word recession? Well, obviously because nobody wants a recession under their watch. No president wants a recession. No Fed member wants a recession, right? So that's why. All right. Beers on me when you travel out to Tennessee. Awesome. Santa rally. I don't think there's really an impetus for a Santa rally, or really. I mean, I would not be surprised if we traded in this range until the end of the year. I mean, we only have 10 trading days or less. So yeah, I would not be surprised if we traded within this range. Any other questions? All right. Let me see. Thanks for taking the time to do this. Very appreciated. Thank you, Onsay. Thoughts on the Atlas crackdown? I read about it this morning. Not surprised. I mean, you know, I wasn't so involved in that storyline, but I did see a few people post some tweets from the past. And so, yeah, if you are tagging the SEC and, you know, showing your Rolex tagging the SEC on Twitter, probably best not to antagonize the alphabet boys, right? The SEC, the FBI, the IRS, probably not best to antagonize them. So, how do you like being a boxer, a baller, and a trader? I love it. That's why I do that stuff. Damn, they cut to ads on live streams now. Yeah, I guess unless you have YouTube Premium. What is your belief or thought process to keep your emotions or expectations in check? I've never really been, I've talked about this before, but I've never really been someone that has had a problem with that when it comes to trading. I will say that just like anything, just like any sport, practicing as much as you can makes it so much easier during game time, right? So paper trading makes it so much easier. And proving to yourself first that you're profitable through paper trading makes it so much easier when you actually take live trades. But the second thing that I will tell you is, don't stare at your P&L. If you look at your profit and loss, and that's how you determine whether to exit trades, then you've gone too heavy, right? You shouldn't be looking at your profit and loss. You should be looking at the chart to determine whether you should be entering or exiting trades, not the P&L. So why do you think bond rates are dropping despite the fact that the Fed funds rate will keep rising? Bond rates are flat and the 10 years actually slightly up. It's not, hasn't really dropped. It's flat. Every time the Fed raises rates, do banks liquidate stocks? No. Sold my puts too early on the first drop at 11. Could have played the trade better. Would you recommend holding the strangle until 11:30? Yeah, that's what I did. I mean, I did it live on here. I said I was holding because the strangle was up 15%. And I said, when Powell starts talking, that's when you tend to see the biggest moves. So I waited until Powell started talking. Did you buy your strangle or sell it? I bought a strangle and I sold it for profit. So if you're asking if I was short a strangle, no, I wasn't. Market's coming back up again. Yeah, we have 45 minutes until power hour. Like I said, you never know what the market is going to do after the information is digested. A lot of times we do see delayed moves. I don't think there's really a reason here to, I think there's less of a reason to rally than there is to tank, right? Because of the terminal rate, looks like it was, the terminal rate looks like it's going to be a lot higher than thought. So, but I don't really see a need to rally either. I would not be surprised if we traded sideways in this range until the end of the year. You tend to see lower volume during the end of the year too. All right. Yeah, I mean, in terms of the psychology, again, like I never really had a problem with the psychological aspect of it, right? I think that where the weak psychology comes from, it really comes from two places. It comes from, one, your position size being too heavy, and so you're looking at your P&L and you're afraid. And two, it comes from the fact that you haven't practiced your strategies enough. That's really where the anxiety comes from. If you've practiced enough and you're like, I know my strategy, this is what I do each and every single time, and then you can apply that to your actual dollar trading, and you can actually manage your position size to where you're not just monitoring your profit and loss as opposed to looking at the chart. That will make it a lot better for you, honestly. But yeah, that's a lot easier said than done, right? All right. I think we will end it there. Shout out to you guys that took the strangle, that were there in the beginning of the chat. Remember, this weekend, December 17th, we have a free webinar, which is basically our mastermind call. We'll be going over day trading, futures, options, etc. Booked 50% on that strangle. Amazing. If you guys do want access to the academy, make sure you take advantage of the year-end pricing discount before prices go up next year. Appreciate each and every one of you for joining. Apologies, still a little under the weather, so if my energy levels are down, that is why. Don't hold it against me. But I enjoy doing these. Who will win the World Cup? Probably Argentina. I will see you guys in the next one. Stay safe out there, traders. Peace.